In the last 3 years alone, Americans watched something almost unbelievable happen. Over $7 trillion in household wealth vanished on paper during market downturns. Retirement accounts shrank, home affordability collapsed, credit balances exploded, and everyday people began feeling poorer even while working harder. That is the real story behind today's economic anxiety. The money didn't disappear from the world, it simply stopped working for ordinary people. And once you understand that, you understand the bigger, more dangerous question economists have avoided saying out loud. What happens when the entire world hits a point where money itself stops functioning the way it is supposed to? Because the signs are already here, and they're happening faster than most Americans realize. Most people hear the word trillions so often that it stops feeling real. But trillions are real. Trillions decide whether your mortgage rate jumps from 3% to 8%. Trillions decide whether your retirement grows or disappears. Trillions decide whether your grocery bill doubles. And trillions decide whether the financial system keeps moving or freezes. The truth is simple. The global economy is sitting on top of a $100 trillion imbalance, a silent pressure that doesn't explode overnight, but grows beneath the surface until the system can no longer carry its own weight. And when that moment comes, the world doesn't run out of dollars. It runs out of stability, out of liquidity, out of trust, out of the very conditions that make money worth something. Money doesn't vanish when banks close or governments collapse. Money dies when the system that creates it becomes too stretched to support it. And right now, that system is cracking. You don't need a degree in economics to feel it. Americans feel it every time they look at their credit card bill, their rent invoice, their shrinking savings, their paycheck that doesn't stretch. Something is breaking beneath the surface, and that something is the foundation of global money itself. The first sign is debt. Not just personal debt, but global debt. Total worldwide debt has crossed $300 trillion, and more than $100 trillion of it sits in a danger zone. Too expensive to refinance, too large to repay, and too interconnected to fail without consequences. Cheap money hid the problem for years. Low interest rates made governments reckless, corporations aggressive, and households dependent on credit for survival. But the moment interest rates surged, the illusion disappeared. The cost of money changed, and the entire machine began to shake. For decades, the world lived on borrowed time and borrowed money. Governments financed budgets with debt instead of revenue. Corporations expanded using loans rather than profits. Consumers relied on credit cards instead of wage growth. Even banks used borrowed liquidity to stay solvent. And it all worked until money stopped being cheap. When interest rates doubled and then tripled, the world discovered the truth. Most of the global economy was never built to survive expensive money. This is the real beginning of the $100 trillion disaster. Not a sudden collapse, not a dramatic headline, but a slow suffocation. A moment when governments realize debt costs more to maintain than their budgets can support. When corporations realize refinancing will destroy their profits. When banks realize liquidity is shrinking. When consumers realize every dollar buys less. And when the world realizes the system that creates money is running out of capacity. But the financial problem is only half the story. The other half, the more dangerous half, is trust. Money is nothing without trust. A dollar is worthless unless people believe someone else will accept it. A government bond is worthless unless investors believe the government will pay it back. A bank deposit is worthless unless depositors believe the bank will return it. Trust is the invisible fuel of the global economic engine. And trust is cracking. You can see the cracks everywhere. Countries hoarding gold at record levels because they trust metal more than currencies. Investors pulling money from riskier markets because they trust stability less than before. Banks tightening lending because they trust borrowers less. Consumers increasing credit usage because they trust their income less. And governments arguing over budgets because they trust their own fiscal position less. The most alarming signal comes from central banks. Over the last 2 years, they have been buying gold faster than at any point since the 1960s. That is not a coincidence. They are preparing for a world where paper money becomes unstable, where global liquidity becomes scarce, and where trust becomes the rarest currency of all. The second major sign of the global money crisis is refinancing risk. Much of the world's debt isn't long-term. It's short-term, constantly rolled over, renewed, and refinanced. That means governments, corporations, and banks survive only as long as lenders remain willing to extend credit. But when interest rates rise, refinancing becomes dangerous. What was once cheap becomes lethal. A loan that cost 2% now costs 7% or 10%. A debt load that was manageable becomes impossible. This is how countries run out of money. This is how corporations run out of money. This is how banks run out of money. This is how households run out of money. Not because the number in their account goes to zero, but because the system stops allowing money to flow freely. A world that runs out of money is not a world where bank vaults are empty. It's a world where liquidity is frozen, credit is unavailable, trust is broken, and the system lacks the fuel to keep moving. It's a world where even strong economies feel weak, where even large companies feel fragile, where even working people feel poor. And the most frightening part? We've seen small versions of this before. In 2008, the world nearly ran out of money when banks froze. In 2020, the world nearly ran out of money when economies shut down. In 2022 to 2023, the world nearly ran out of money when inflation forced interest rates higher. Each time, governments rescued the system with massive injections of liquidity. But you cannot inject your way out of a $100 trillion imbalance. You cannot stimulate your way out of structural fragility. You cannot print trust. The machine is straining. Every part of the system is signaling pressure. The U.S. government pays more than $1 trillion a year in interest payments alone, more than its military budget. American households hold over $1.2 trillion in credit card debt, the highest in history. Corporate America faces $5 trillion in refinancing over the next 3 years at interest rates far higher than when the loans were issued. Banks are sitting on hundreds of billions in unrealized losses. And consumers feel poorer even when they earn more. Money hasn't disappeared. Money has broken away from reality. And once the world understands that the system has grown bigger than the economy supporting it, the illusion ends. That is the $100 trillion disaster. Not a moment, not a headline, but a slow, unstoppable drift toward a world where money stops functioning the way we expect. This is where the story begins, what happens next, and what it means when the world starts running out of the one thing we always assumed would last forever. The real danger of the $100 trillion disaster shows itself when you stop looking at debt as numbers and start seeing it as pressure. Pressure on governments trying to refinance. Pressure on corporations trying to survive refinancing waves. Pressure on banks trying to stay liquid. Pressure on households trying to stretch the same paycheck across a world that has become more expensive, more unstable, and more unforgiving. When pressure builds across multiple layers of global finance at the same time, the system doesn't break immediately. It warps first, quietly, invisibly. And that is exactly what is happening right now. You can see this pressure in the most ordinary places, on a family budgeting spreadsheet, on a small business loan application, on a bank's quarterly report. A world that is running out of money does not mean the world is physically empty. It means the system that circulates money is struggling. And everywhere you look in 2025, circulation is slowing. Start with governments. Over 50 countries today are spending more on interest payments than on education, healthcare, or national security. That is not a normal financial environment. That is a warning siren. When governments owe too much at high interest rates, every budget becomes a crisis. Every election becomes a financial gamble. Every recession becomes a threat. Nations that once controlled their financial destiny are now controlled by their refinancing schedules. They aren't running out of money. They're running out of room to maneuver. And in the world of economics, losing flexibility is the first step toward losing stability. Corporate America faces the same trap, just with less media attention. During the era of cheap money, companies borrowed as if interest rates would stay low forever. They built business models around 2% to 3% financing costs. But now that those loans are maturing at 7% or 9%, the math no longer works. More than $5 trillion of U.S. corporate debt comes due over the next 3 years, and refinancing will strip hundreds of billions in profit from the largest companies in the country. Some companies will survive, many will not. And the problem is not bankruptcy alone. The problem is what bankruptcy takes with it: jobs, pensions, credit lines, suppliers, productivity, and confidence. When enough companies struggle at the same time, the entire ecosystem tightens. Lenders become cautious. Investors pull back. Small businesses lose access to credit. Hiring freezes spread quietly. Consumers sense instability. And the world moves one step closer to a liquidity freeze, a moment when the system has money but refuses to move it. Banks feel the pressure most intensely. Banks are the bloodstream of the global economy. And when the bloodstream experiences pressure, every organ suffers. Many banks today are holding massive portfolios of low-yield assets purchased during the zero-rate era. Now those assets are worth far less, creating unrealized losses that erode banking strength. Banks can hide these losses temporarily, but the losses still exist. Higher interest rates make their funding expensive. Withdrawals move faster than ever through online banking. Depositors chase higher yields. And banks compete aggressively for liquidity just to stay stable. A banking system under pressure becomes timid. Timid banks lend less, and when banks lend less, the economy shrinks. Not because people stop wanting money, but because money stops wanting people. Households are not spared. In fact, households feel the pressure more than anyone. For the average American, money is harder to make and harder to keep. Not because they suddenly became irresponsible, but because the economic environment itself has weakened. Wages have not kept up with living costs. Housing has become a luxury. Credit cards act like anchors. Savings erode under inflation. Families who once had margin now live month to month. People who once felt secure now feel exposed. When millions of households feel squeezed at the same time, the entire economy loses resilience. A financially fragile population cannot absorb shocks. It cannot drive consumption. It cannot support growth. It cannot protect the system from failure. Zoom out, and you see the pattern. Governments feel pressure. Corporations feel pressure. Banks feel pressure. Consumers feel pressure. When pressure aligns across every major pillar of the economy, the world doesn't collapse instantly. It suffocates slowly. Another hidden danger is liquidity fragmentation. For decades, money moved smoothly around the world. A dollar invested in the U.S. could easily flow to Europe, Asia, Africa, or South America. Global trade depended on this mobility. But recently, geopolitical tensions, sanctions, currency disputes, and central bank divergence have disrupted the movement of money. When money becomes segmented, when dollars stay in one region, euros stay in another, yuan stay in another, the global system loses efficiency. Some regions end up with too much liquidity, others with too little, and the imbalance destabilizes markets. China's declining foreign investment, Europe's weakening industrial engine, America's rising borrowing costs, and emerging markets, currency instability are not isolated stories. They are interconnected symptoms of a global system being stretched beyond its limits. When the world's financial connectivity weakens, money becomes harder to move, harder to access, and harder to rely on. That is what running out of money looks like, a breakdown in circulation, not a shortage of currency. Another part of the $100 trillion disaster is the explosion of shadow debt, loans, investment vehicles, derivatives, liquidity channels, and obligations that exist outside traditional banking systems. These instruments amplify gains in good times, but multiply risk in bad times. Nobody knows exactly how much shadow debt exists, but estimates suggest it's more than $60 trillion globally. The danger is not the number alone, it's the opacity. Nobody knows who owes what to whom. Nobody knows who will fail first. And nobody knows how the failures will cascade. This lack of transparency means the global system could experience a sudden freeze without warning. A major fund fails, or a giant corporation defaults, or a sovereign state collapses, and overnight liquidity tightens everywhere. Banks stop lending. Corporations hoard cash. Households panic. Money still exists, but its movement, its power, is gone. One of the most dangerous catalysts in this looming disaster is demographic pressure. Aging populations across developed nations mean fewer workers supporting more retirees. Pension systems strain. Healthcare spending rises. Tax revenues shrink. Labor shortages increase. Productivity slows. Governments borrow more to fill the gap, adding more weight to already massive debt burdens. A shrinking workforce supporting growing financial promises is a formula for long-term instability. When promises exceed the system's ability to keep them, confidence breaks. And when confidence breaks, money follows. Energy volatility adds another layer of risk. Energy is the foundation of economic activity, And when energy prices fluctuate dramatically, the cost of everything fluctuates. Businesses delay investment. Households reduce spending. Governments face budget pressure. High energy costs act like a tax on the entire world, draining liquidity from every sector simultaneously. A world struggling with debt cannot easily absorb energy shocks. When energy becomes unstable, money becomes unstable. The deepest problem, however, is productivity stagnation. Wealth is created when societies produce more value with less effort. But in many countries, productivity growth has slowed for years. High costs, heavy regulation, aging populations, educational gaps, and declining innovation have all contributed. Without productivity growth, debt becomes harder to service. Without productivity growth, wages stagnate. Without productivity growth, wealth creation slows. A world with rising debt and falling productivity is a world where money becomes less effective, less valuable, and less sufficient. All these forces together create the environment where the world runs out of money. Not physically, but structurally. Money becomes harder to access, harder to trust, harder to move, harder to rely on, harder to use for building a future. The global system begins to feel like a machine operating beyond its capacity. The tragic part is that ordinary people feel the consequences first, long before politicians or executives or academics acknowledge the crisis. Households sense financial tightening before central banks report it. Businesses feel credit contraction before analysts measure it. Consumers see price changes before inflation data confirms them. People feel scarcity before the system admits scarcity. And that becomes the psychological spark. When millions of people start believing money is becoming less reliable, less stable, or less sufficient, they change behavior. They save more, spend less, invest cautiously, take fewer risks, avoid major purchases, pull money from markets, delay life decisions. This behavioral shift slows economic activity, which deepens the liquidity problem, which reinforces the sense that money is drying up. Scarcity becomes a self-fulfilling prophecy. That is the most dangerous dynamic in the $100 trillion disaster. The moment when financial pressure turns into financial fear, and financial fear turns into financial paralysis. A world that stops moving money is a world that stops functioning. And this is exactly where the story turns from pressure to consequence. Because once global systems approach this threshold, the real question becomes, what happens next? The final stage of the $100 trillion disaster is not collapse, it's transformation. Before a financial system breaks, it bends. Before it crashes, it reshapes itself under pressure. And that reshaping is already happening in ways most people don't see. To understand what happens when the world runs out of money, you have to understand how societies behave when the system that supports money becomes too fragile to trust. What follows is not a sudden global blackout, but a slow, uneven shift in how value is stored, how trade is conducted, how governments react, and how ordinary people survive. The first consequence is the rise of parallel financial systems. When confidence weakens in one monetary network, people and institutions search for alternatives. This is why so many countries are building their own digital currencies, their own payment rails, their own gold reserves, and their own independent systems for trade settlement. The world is quietly drifting away from a singular monetary order to a fractured set of competing ones. This fragmentation doesn't look dramatic at first. It looks like trade agreements that avoid the dollar. It looks like central banks buying gold. It looks like nations building digital monetary systems outside Western control. It looks like corporations holding more cash and fewer long-term investments. Each of these decisions is small. Together, they signal something huge. The world is preparing for a future where stability cannot be taken for granted. A global financial system under strain also accelerates inequality. Those who already have access to financial stability, strong credit, good income, valuable assets, gain the ability to protect themselves. They shift into hard assets. They buy property. They acquire businesses. They reduce leverage. They diversify internationally. But ordinary households do not have this flexibility. Their income is fixed. Their savings are small. Their debt loads are heavy. They operate on a tight monthly cycle and have little room to adapt. When money becomes harder to access and trust weakens, the vulnerable are hit first and hardest. The system doesn't run out of money equally. It runs out unevenly, starting at the bottom. This widening gap affects the economy in subtle but powerful ways. When middle-class households cannot spend freely, consumption declines. When consumption declines, businesses reduce investment. When investment declines, job creation slows. When job creation slows, wages stagnate. When wages stagnate, mobility collapses. This cycle reduces the overall financial oxygen in the system, deepening the feeling that money itself is becoming scarce. Even if trillions exist in the financial world, they become concentrated and inaccessible, creating the lived experience of scarcity. The next consequence is currency instability. When a financial system approaches its limits, currency volatility increases. Money becomes unpredictable, not worthless, but unreliable. People lose confidence in long-term contracts, in fixed rates, in predictable budgets. Exchange rates fluctuate. Import prices swing. Businesses hesitate to make commitments. Governments spend more to defend their currency. And investors begin searching for safe havens, which can trigger capital flight from weaker economies. This is how countries run out of money. Even when their banking systems still function, they lack stable purchasing power and lose the ability to secure external funding. Stability erodes from the outside in. At the same time, governments respond to financial strain in predictable ways. Some cut spending. Some raise taxes. Some borrow more aggressively. Some print money to cover shortfalls. Some implement capital controls. Some restructure debt. And a few eventually default outright. Each government chooses based on political self-preservation rather than long-term economic health. But all of these choices have consequences that ripple through the global system. A default in one country raises borrowing costs in others. A currency collapse in one region triggers capital flight in another. A bailout in one sector makes investors cautious in others. The global system becomes fragile, prone to sudden shocks. A world under financial strain also becomes more politically volatile. Economic stress weakens trust in institutions. People begin blaming leaders, systems, foreigners, corporations, the wealthy, anyone who seems responsible for the pressure they feel. Political parties polarize. Social movements rise. Elections become unpredictable. Governments become unstable. Economic stress leads to political stress, and political stress leads to policy unpredictability. And unpredictability is the worst possible environment for financial systems. Businesses freeze investment. Households freeze spending. Global investors withdraw. Money stops moving. But the most revealing part of this entire disaster is how individuals adapt. Because in every financial crisis in history, people always adjust their behavior before institutions adjust theirs. In a world slowly running out of money, the first adaptation is caution. People save more when they can. They reduce unnecessary spending. They hold more cash and fewer discretionary assets. They become selective about large purchases. They delay decisions. This behavior slows the economy even further, reinforcing the cycle of contraction. The second adaptation is substitution. When money becomes tighter, people change the way they consume. They choose cheaper brands, smaller quantities, or secondhand goods. They trade down in housing, cars, and lifestyle. They focus on essentials. They avoid debt. This substitution reshapes entire industries: retail, travel, entertainment, real estate, automotive, hospitality. It shifts economic power away from premium markets and toward survival markets. And when millions of people do this simultaneously, the world experiences a psychological recession even before an official recession is declared. The third adaptation is diversification of value. When trust weakens in traditional money, people and institutions diversify into alternatives: gold, commodities, land, digital assets, inflation-linked securities, foreign currencies, or even barter-like exchanges in extreme cases. This diversification is not just a financial strategy, it is a psychological strategy. People seek stability in a system that no longer provides it. They seek value that cannot be printed or inflated away. They seek something real. This shift toward alternative stores of value accelerates the decline of trust in traditional money. And trust, once broken, does not return quickly. A system can survive inflation, interest rate hikes, recessions, and even political instability. But a system cannot survive without trust. The final stage of the $100 trillion disaster is the reordering of the global financial hierarchy. For over 80 years, one monetary system dominated the world: dollar-based, debt-driven, globally interconnected, and supported by strong institutions and stable economic leadership. But that system is aging. It is burdened by massive debts, political division, global competition, and structural imbalances that are no longer temporary, but permanent. As the system weakens, new systems rise. Some may be regional, some may be digital, some may be commodity-linked, some may be government-controlled, some may emerge from technological innovation rather than political agreements. The transition will be slow, uneven, and messy. It will create winners and losers. It will produce instability. It will generate new opportunities. But what matters most is this: when the world runs out of money, not physically, but structurally, it forces a reset. A reset of expectations. A reset of systems. A reset of what money even means. For ordinary people, the path forward is not hopeless. It is simply different. The world is changing, and money is changing with it. Those who understand the shift early can adapt. They can prepare. They can protect themselves. They can position for a world where trust, stability, and liquidity are no longer guaranteed, but must be earned. When historians look back decades from now, they will not describe this era as a sudden crash. They will describe it as a long, slow turning. A period when the old system ran out of room, out of leverage, out of time. A period when the world didn't run out of money, but out of the conditions that made money work. And that is the truth behind the $100 trillion disaster. The world doesn't collapse when money ends. The world transforms when money stops doing what it used to do.